think we have the power within ourselves to change the market. But unfortunately, for some reason, a lot of American commentators are very heavily focused on Wall Street and in terms of COMEX. And I don't deny that there's that there's a lot to the COMEX and Wall Street, but I think that some of that emphasis is misplaced, and that more education for retail investors across the world would be more beneficial to bringing real price discovery to investors worldwide.
As a leader in uranium discovery in Argentina, Blue Sky Uranium is focused on advancing a rapidly growing portfolio of uranium vanadium projects into low-cost production, while respecting the environment, communities, and cultures in which they work.
Welcome to Inside the Markets, StockPulse.com production here. I've got John Adams of Adams Economics here from Australia here. So, John, appreciate you taking the time here from down under. It's been quite a while here. Think about you a lot. I know it's been a rough time in Australia, and I guess you kind of hit some big news here today with record inflation. So that might be a good place to start our conversation. You're in the metals markets here, a good place to combat inflation. So, John Adams, appreciate you joining me.
Thank you, Rob, for in terms of the invitation. So it's Wednesday here in Australia, and we're just after 1 p.m. here in the afternoon. And so only in the last couple of hours did the official statistical agency for the government, the Australian Bureau of Statistics, come out and say that headline annual inflation is at 5.1%, which is the highest in 20 years. And obviously in the United States, you've got year-on-year inflation at 8.5%. So we are seeing surging inflation across the world. Part of it is obviously driven by the response to COVID-19 with extraordinary fiscal and monetary policy. But obviously in the last couple of months, a lot of it has also been driven by the situation in the Ukraine between Putin in terms of his invasion of the Ukraine, and what has that meant for the supply of energy, but also in terms of geopolitical risk and confidence in the markets. And that's sort of driven particularly gas and fuel prices to a very high level. So there's some structural stagflation happening. There is some temporary factors also, and obviously what that means in terms of central bank responses, we've obviously seen already an initial increase in interest rates in terms of the U.S. Federal Reserve. The U.S. Reserve, the FOMC is going to meet next week. And there's obviously expectations that there could be another quarter point to half a point rise, pretty much in the next 7 days in terms of America. Now, in terms of Australia, we actually had more extraordinary monetary policy compared to the Americans. So we went to 0.1% on the official cash rate. We did quantitative easing. We did yield curve control. We did something. We had what they called the term funding facility, which was they printed money out of nothing and provided the commercial banks with cheap financing of about 0.1%, which was much cheaper than what the market rates are. So a lot of those accommodative policies have now been relaxed. Yield curve control has stopped. Quantitative easing stopped in February. And the only last thing to do is to start raising interest rates. So part of the issue for Australian consumers, particularly mortgage holders, was the RBA was making all sorts of public statements last year that interest rates were not going to rise until 2024. Now that we see surging inflation, the RBA has no choice. But even in the last couple of hours, the newspapers are now saying that we could start to see a rate rise in terms of the May meeting, which is only, I think, next week. So we could start to see some rate rises in Australia. And now we have a very different sort of economy in Australia compared to the United States. We have the biggest household debt bubble in Australian history. If you look at proportional terms, our debt bubble is way bigger than where the United States was before the GFC in terms of household debt. So a lot of Australians have borrowed to the hilt, particularly in property, and property prices are at a ridiculously extreme level. Property prices during the pandemic, when we've had all this extraordinary monetary policy, has risen by about 30%. And so now that fixed rates and long-term rates are starting to creep up a bit. Property prices in some parts of Australia have already started to fall about 10 to 15%. So, and that's just on the ending of quantitative easing and tight margins and raising of long-term rates in terms of the commercial bank. So, if we get into next week, if we see that the RBA, the Reserve Bank of Australia, starts to increase the official cash rate, what we're going to see is potentially a preliminary taming of inflation, but we're going to see a lot of Australians who have borrowed way beyond their capacity to really struggle, because a lot of people are struggling at the moment. And mortgage stress, according to some measures, is 40% in Australia at record low interest rates. So if interest rates start to go up, you could see, who knows, 45, 50, 55% of households struggling to make ends meet. And, there's a lot of people who have been sucked in by the propaganda of the government and the banks in Australia in terms of borrowing and, having a go and, trying to get a mortgage and trying to get ahead. And unfortunately, a lot of this propaganda and advice has misled people to borrow way beyond their means, just like how it happened in the United States prior to the GFC. And I think there's going to be a lot of pain for middle class households across Australia, probably in the next 6 to 12 months.
Yeah, so let's talk about the Fed's moves here. They've obviously signaled rate hikes here. You've certainly slowed the housing market down here in the U.S. and, as you said, Australia. But where's the rubber meet the road here? Is their move really to continue to raise rates, or you're a far smarter man than me, John? Explain the damage that will happen as you move rates higher. How are you going to tame inflation when you've already put so much money into circulation? I don't see any way out of this. Explain where they're at here.
Yes, so I mean that's a very good point. Now, my view on this, Rob, is more about politics than it is about economics. So basically, at the end of the day, there's a certain amount of interest rate rises that central banks can do before we get into a financial crisis. So at some point, if rates were to go too high, you would start to see some sort of massive default, whether it's a government or a hedge fund or a bank or potentially households not being able to pay. And then you'd see the sort of Lehman moment, what happened in September of 2008, where you get a big systemically important bank falling over, and then the financial markets go into crisis. So now, how many interest rate rises can they afford before the financial system starts to get into peril? That's the $64 million question. In the case of Australia, the official interest rate before the pandemic was 1.5%. Like I said before, we're at now 0.1%. My view is that we can't go back to 1.5% because there is so much more debt compared to where we were in 2019. Dare I say that I think it's a very similar sort of situation in terms of the United States. So it could be, there are some people in America, some people in Australia saying that it's going to be 6 rate rises and they're going to be super aggressive. I just don't see how that's plausible, particularly because it's just going to take a couple of rate rises and you're going to start to see the economy slow down. And obviously there's been some videos on YouTube coming out of America already saying that we're already starting to see a slowdown in terms of the housing market. So so what I suspect is going to happen is that we're going to see some rate rises, the economy will slow down, the central banks will start to change their tune, and that's when they're going to start cutting again. And then that's when they're going to start to go into negative interest rates. One of the one of the really important factors in Australia was that during last year with the lockdown and the COVID-19 pandemonium, at the same time you had all this talking about inflation. The banking regulator in Australia, called the Australian Prudential Regulation Authority, they actually came out with guidance about negative interest rates. So they came out with draft expectations in July of last year, and then by October they came out with their final expectations. And what they basically have instructed the banks to do is that by October 2022, Australian banks must have, quote, tactical solutions to implement negative interest rates. So you'd think to yourself, well, if the rage is inflation, if the rage is raising interest rates, why would the regulator tell the commercial banks to get operationally ready for negative interest rates? And so I think they have really revealed the real agenda here. And the real agenda is that once the economy starts to slow down by a few rate rises because the debt is so large, the only way to save the debt bubble is to start cutting again, and that's when they'll have to be more aggressive than what they have done in the last 2 years. And I'm anticipating we're going to see negative interest rates in Australia probably by 2024. I wouldn't be surprised if that happens in the United States, and obviously there's a whole host of other factors involved in that, with the central bank digital currency, the freedom of cash, and in terms of how do you ensure that this regime continues on without people withdrawing their capital out of the financial system. So obviously the big risk with negative interest rates is people don't want to pay those negative interest rates. They pull their money out of the system. They either buy cash or they buy precious metals, and so they're able to escape the financial architecture that the central banks are putting together. So I mean that's sort of where I think the economy is headed, and one of the other sort of prominent economists that's dancing a very similar tune to that is Peter Schiff, who's also saying there's a limit to how much the central banks can raise rates before they have to start cutting again. And so, in terms of my sort of medium-term macroeconomic forecast, I mean, the reality is that we have stagflation at the moment. I mean, I came out with a call in mid-2020 saying that we have stagflation in Australia. I think that stagflation has now exacerbated itself, and where I think we're going to see even stronger stagflation over the next 2 years. So I think there'll be a bit of calming in 2022, and then I think it's going to start to pick up again as we go into late 2023, 2024. And obviously for long-term to medium-term holders of precious metals, I think it's going to be a pretty encouraging macroeconomic environment for precious metal prices to go higher from where we are today.
Yeah, you're reading my mind there. I was going to shift gears into precious metals after the commentary you just gave me there. It assures me of my positions and my outlook here. So, let's get into how you see the markets right now. Pretty choppy. I don't know. Your guys have been pretty outspoken about manipulation here, or so many things may not be what they seem. So, talk about the direction you see them. And I think the forecast you gave there certainly is a rosy picture for the metals with all this fiat currency in the system. So, talk about your feelings here on the metals, John.
Sure, yes. So I mean, look, I think we're in a very fantastic macroeconomic environment for real assets, including all sorts of commodities, including precious metals. Now, one of the obviously surprising things is that we have the Silver Institute coming out with a report. I mean, Chris Marcus from Macroeconomic only did a show in the last 12 hours, I believe, which he talked about the Silver Institute forecast, and the forecast is quite extraordinary. It says we're going to have record investment demand for 2022. We're going to have a deficit in terms of demand versus supply, and somehow the price is still going to fall by 5%. So I think the Silver Institute is forecasting that the silver price by the end of 2022 is going to be around $23 or $23.50 as opposed to $25, $26. And so the real big frustration for precious metals investors is, so I was accumulating quite a bit of silver prior to July of 2020 when the price was $13, $14, $15, $16, $17 an ounce. And then obviously once we hit in terms of mid-July, when there was a huge problems in terms of the COMEX, the price shot up from $17 all the way up to it peaked at 30, and then ever since then, over the last 2 years, it hasn't been able to crack 30. Hasn't been able to crack $30. And so the real question is, with all the record demand for gold and silver, across the world, central bank demand, wholesale demand, institutional demand, retail demand. So when you have all of that, and we have supply chain problems, and particularly with COVID, and not all the mines being able to supply, but also you put that on top of the macroeconomic environment. Why has the price of silver been stuck below $30 for the last 2 years? And I mean, here's where you're getting into the very interesting debate. And before we started this interview, we talked about the silver symposium that you ran last year and that's coming up this year. I mean, you have certain commentators in the market, and a lot of them are American, and I spent a lot of years listening to them before I became a commentator myself, who talk about systemic multi-decade conspiracy theories around in terms of market manipulation, and a lot of this is not fanciful. In the 1960s, we had what was called the London Gold Pool, which was a secret official agreement between 7 central banks to fix the price of gold. And obviously that broke down in 1968. When the British raised interest rates too high, and there was a huge run on gold that they weren't able to excuse me, that they weren't able to cover. So you have a group of people, perhaps me, Chris Marcus, Big Sweetie, David Morgan, Greg Kemke, and others, talking about systemic manipulation across the precious metal complex, whether at a futures market, in terms of the wholesale market, retail market, etc. And then you have the other people on the other side, like people like Peter Schiff or Rick Rule, who say there is, or even Jeffrey Christian from CPM Group, who say there is the potential for short-term manipulation in commodities trading, either on the upside or the downside, but there is no long-term multi-decade conspiracy theory that has been fixing the price. So, perhaps that could be some sort of central theme of the silver symposium coming up here. Why is it we've been waiting for 2 years and the silver price can't crack $30 when you have all the factors in the world that would suggest that prices should be going through the roof? And when you look at other commodities outside of gold and silver, commodity prices across the board are going up, but gold and silver are stuck. And there is no economic justification for it, other than there is corruption and manipulation and things happening both among governments, among central banks, among other market participants, in my view is the only way to get genuine price discovery in gold and silver is to expose the corruption and the fraud. And so we've seen in the last couple of years, we've seen some, I think there was the Department of Justice, that they fined JP Morgan about $900 million. There's also still a criminal probe where a trader basically said he was he was trained by his management team to rig to do spoofing, to rig the markets, etc. So there's plenty of historical examples of people being caught out, whether it's Morgan Stanley in 2007 or JP Morgan in the last couple of years of manipulating the market. But I think there's a lot more manipulation, a lot more tricks, and a lot more sort of tactics in the market that has yet to be uncovered. And hopefully, if we double our efforts in that part of the market, we can bring more truth and transparency to the gold and silver markets, and hopefully that leads to more accurate price discovery, and obviously those investors who have been in the market for long term can get adequate returns on their investment, more so than what they have been able to enjoy to date.
Yeah, and I think, and I'll welcome you here to this year's symposium, John, and we'll have a lot of those discussions with maybe some of those same people about this. So let's talk about maybe how to really get to some true price discovery. I've had several chats with a lot of the people you've mentioned, and if there was a conference call made right now, and Wall Street Silver has gone after this campaign, a stack in silver, take delivery. If everyone just decided to call in their bets right now and take delivery, did you get your true price discovery then?
Yes. Well, I mean that was one of the central points in so the campaign that I was running last year in sort of March and April, both on social media but also in terms of YouTube interviews, was that here's where I think, Rob, a lot of the American commentators get it wrong, because a lot of them are focused on COMEX and they're very focused on what's happening among the banks. But my view is that it's kind of like the Wizard of Oz. Dorothy spends the whole movie going from when she arrives in Munchkin Land to the Emerald City, because she wants to go back to Kansas. And when she gets to the Emerald City and meets the Wizard of Oz, the Good Witch of the North says, you had the power all along. All you have to do is tap your ruby slippers 3 times, and then you get to go back to Kansas. Well, my big thesis is that we don't need to talk about COMEX. We don't need to talk about the banks. I mean, if every retail investor across the world caught in, particularly on unallocated, pool allocated products. There's probably enough fractional reserve schemes happening in that part of the market that you can really put enough pressure right across the precious metal complex that you can start to actually, get a lot more pressure happening in the market, and then that will start to lead to price discovery. So a lot of people are waiting. Ted Butler's been in the game for 40 years, and I've got nothing against Ted Butler, but he's waiting for the day where basically the COMEX collapses and the banks can't continue their games anymore, and that will lead to ultimately the price going to its real price discovery, which could be, who knows, $600 US an ounce. But my view is that rather than waiting 40 years, waiting for the banks to fall over, the retail investors, if there is enough awareness and enough guidance from the leadership of the precious metal community for them to actually call in the silver, like you say, or call in the gold, well, then we can start to get some of these bullion dealerships and people in the wholesale market who are running fractional reserve schemes to fall over, and I think that will be enough pressure to really get price discovery happening. So I think we have the power within ourselves to change the market, but unfortunately, for some reason, a lot of American commentators are very heavily focused on Wall Street and in terms of COMEX, and I don't deny that there's that there's a lot to the COMEX and Wall Street, but I think that some of that emphasis is misplaced, and that more education for retail investors across the world would be more beneficial to bringing real price discovery to investors worldwide.
Yeah, let's a lot of information here, John. Let's kind of reel it in here and maybe consolidate a message here to help investors get out of this scenario alive here. You painted a picture of inflation that might not ever be tamed. So fiat currency isn't going to work. Precious metals, several ways to play them here. Again, we'll discuss many of those ideas while we're here, but for now here, give investors some sort of hope here and guidance here through these tough times.
Sure. Yes. So whether it's in some of your viewers in the US or Canada or even some, if you've got anyone from Australia listening, the reality is that we have the biggest global debt bubble in world history. Central banks are stuck. The power elite, which are both political, economic, people tied to the World Economic Forum, they're not going to relinquish their power. So they're not going to allow a financial crisis to eventuate. So that's why they're not going to raise interest rates too high, because then basically all of their economic, financial power and political power will basically evaporate. So that's why I think we're going to see ongoing stagflation. So people should turn off the mainstream media, try to focus on what's really going on behind the scenes, and obviously take whatever sort of precautions you can to insulate your economic position. So, a couple of years ago, I wrote a 10-point plan of how to prepare for economic Armageddon. I wrote it for one of the main Australian mainstream media platforms, and I, basically common sense thing, low debt, cash flow management, hold good money like precious metals, and then obviously try to have multiple sources of income. So I think this is the perfect time that Americans and Australians need to be alert to in terms of dangers in the economic system, and they need to take all the precautions they can. And if they do sensible, conservative, old ideas that a lot of Americans in the 19th century exercised, then a lot of Americans can get through these tough times in relatively good shape. And obviously I've seen so many examples of where humans across the world, if they are placed under financial pressure, that leads to all sorts of other issues, whether it's health issues, mental health, relationships, etc. So I think a strong financial basis, very conservative approach to spending and saving and in terms of debt and holding sound money, that provides a basis to have a good life, have good relationships, and hopefully have good health and basically enjoy your time here on Earth.
Well said, John. How do people keep track of you and follow your work?
Sure. So I have a website, adamseconomics.com. People can sign up to my newsletter. I send out a newsletter every so often. I have a Twitter handle, Adams Economics. I'm on Telegram as well. I've got a group there, Adams Economics. I'm on Facebook as well. So they're probably the main platforms. If people want to contact me with any questions or follow up with if they wish to get help in buying precious metals, I work for a company called As Good as Gold Australia, which is based in South Australia. So I'm their chief economist. So we can help people. So we do business in North America as well as in Australia. So if people want to get assistance in precious metals, vaulting services, etc., email me at john@adamseconomics.com, and happy to help anyone who needs help.
Okay. And we'll look forward to seeing you here in Spokane this year for the Stock Pulse Silver Symposium a year or two. So, John Adams, appreciate the time, and we'll certainly look forward to checking back in and seeing how some of these predictions go.
Fantastic. Thanks, Rob.